Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is a video series we started last year, and these videos are designed to complement and add value to the Undervalued Dividend Growth Stock of the Week articles. And of course, those articles are part of a series that we started years ago, whereby every Sunday I highlight a dividend growth stock, a high quality dividend growth stock that's sourced from David Fish's Dividend Champions, Contenders, and Challengers list. And I take one of those stocks and I basically highlight it as a compelling long-term investment idea for that particular week, based on the fundamentals of the business, based on the quality, based on known risks, and of course, perhaps most importantly, based on the valuation at the time of the publication of the article. So welcome to another video today. Of course, we're doing 2 of these videos a month, so we're selecting, we're writing 4 to 5 Undervalued Dividend Growth Stock of the Week articles per month, depending on how many Sundays there are in a month. And then twice a month I'm shooting these videos. So I'm taking 2 of those articles and I'm selecting a couple of them out of the 4 or 5 that we have per month, and I'm taking I'm delving into that particular article via this video. So what this video does is, when you read the articles are between 2,000 and 2,500 words, depending on the type of business we're getting into and depending on what we're talking about. So when you're reading through that article, and I'm just kind of pumping out some ideas and putting out some numbers out there, and maybe people are kind of like, oh, what is he talking about here? Where's this number coming from? Where's this concept at? So these videos basically kind of clear all that up, and I break down everything, actually go through the financial statements and go through some of my ideas and kind of explain things with a little more depth, because even though the articles, you would think that 2,000 to 2,500 words would explain everything you need to know, but when you're talking about investing in a publicly traded company, and certainly when you're talking about some of the concepts I'm getting into with financial independence and saving and investing, 2,000, 2,500 words is just not even scratching the surface. So these videos are designed to kind of add to that a little bit. So we'll get right into today's article for today's video. And of course, the Undervalued Dividend Growth Stock of the Week series, you can find the entire archive of articles. If you're at dailytradealert.com, you click on the Dividend Growth Investing heading there, and then you click on the Undervalued Dividend Growth Stock of the Week tab, and that'll take you to the entire archive. For today's video, I selected IBM, which is, as of the shooting of this video, which is the 25th of March. That was the most recent Undervalued Dividend Growth Stock of the Week article that was published. Of course, by the time that this video is actually published and live and you guys are actually watching it, there'll be probably more articles published and everything else, because we're doing them once a week. So I'm going to click off the archive. I already have the IBM article pulled up, and of course, with every article that I publish every Sunday, I start out every article with what I call a big idea, which is a concept. It's a different concept every week. It's kind of a different way of drawing you readers in and trying to provide food for thought, provide value, and kind of to get you to buy into some of the things we're talking about. Because frankly, it doesn't positively impact me in any way if someone out there reads what I'm talking about and says, wow, this really inspired me, I'm gonna go out and save and invest in everything else. I mean, that doesn't financially benefit me in any way, but it makes me feel great if I can positively impact people out there. And frankly, because of the way the world works, I mean, if you're able to improve your finances, you're able to dramatically improve your life, your quality of life, your happiness, your opportunities, your flexibility, your freedom, and everything else. So, and one of the things I talk about in this article, kind of the initial concept that I'm broaching here, is that I kind of feel sometimes like the public education system in America has failed people and continues to fail people, because while we're studying, the periodic table of elements and we're dissecting frauds and stuff, that's not really helpful for everyday life once you become an adult and once you actually have the responsibilities that lie therein. You're not going to need to you're not going to go to work every day and recite the periodic table, right? You're things that are going to impact you on an everyday basis are generally things that aren't really kind of approached with any depth, or sometimes approached at all in our public education system. And so one of the things I talk about is that nobody ever talked to me about money, about how to budget, about the power of compounding, how to invest, or anything else. And so because I was kind of ignorant to money, that ignorance really held me back, especially throughout my early 20s. I ended up in debt, and I went to college and took on student loan debt, and I wasn't real sure what I wanted to do with my life. And I felt like, high school, I'm not blaming anyone or anything, but I felt like high school didn't really prepare me for a life. And one of the main aspects of our lives is our relationship with money, how we interact with money, and what we do with our money. That's going to have a major impact on your quality of life, what you do in life, where you end up, how successful you are, and everything. And so I kind of talked about that, about how I was ignorant to it. I worked to earn to spend. I invested nothing. I bought things I didn't need with money I didn't have. I'm sure plenty of people know what that's like. Finding myself overworked, overstressed, and below broke in my mid-20s, it was sobering. And then, I was let go from my job during the depths of the financial crisis, and that was the lowest financial point I've ever experienced. I was working for a car dealership for one of the big three domestic auto manufacturers just outside, well, actually in Metro Detroit, so just outside the actual city of Detroit. And this was in 2009, in March of 2009. And they let me go. They let a lot of people go, the dealership I was working for. And that's because, the big three auto manufacturers were having a lot of problems back then, and Detroit was kind of the epicenter for those issues. And there was a lack of inventory, lack of customers, and they didn't need as many people. So they let a lot of people go, and I was one of them. And it is what it is, or whatever. But it certainly forced me to kind of wake up and get a handle on my finances, because I found myself in debt, unemployed, and I said, I'm not an unintelligent guy. So how did I get myself in this situation? Well, it's kind of the lack of preparation throughout my life that really led me to that position. And I'm not blaming anybody for that. I certainly need to account for that on my own, and that's what I did. I started to account for, take ownership of my mistakes and everything else I made in life, and I decided to educate myself. If nobody cares more about your money than you, that's what they say, and this is very true. Your high school teacher doesn't care about your money. Your college professor won't care about your money. Your parents probably don't care too much about your money. You need to care about your money. Because until you care about your money won't care about you. So it's just how it is in the States. I had to educate myself, and I had to change everything all alone. And that's what today's article is all about. These articles are designed to inspire you, to help you, and educate you, and provide you with the tools necessary to improve yourself, at least in the financial sense. And when you improve yourself in the financial sense, you tend to improve yourself across the board, because if you kind of free yourself up, all that time and stress and everything else that goes into worrying about money, then you're able to allocate those resources in a far more effective manner across your entire life. And it starts to totally holistically change everything about you and how you go about living and how you go about thinking and everything else. And it's really a wonderful transformation. And so, yes, if you go out and read my articles and save and invest, do I get, a check for that? No. But it makes me feel wonderful to know that someone comes across this stuff and starts to positively change their life. And that's really all the reward I need. I mean, I live and breathe this stuff because I have personally benefited from it so much, and I feel like I'd be remiss if I didn't share those benefits with the world in some way, in some small capacity, which is what I do. So I changed everything around, and I started dividend growth investing in early 2010, and I started investing in high-quality dividend growth stocks that you can find on David Fish's Dividend Champions, Contenders, and Challengers list. That's a compilation of more than 800 U.S. listed stocks that have been paying increasing dividends they've raised their dividends each year for at least the last 5 consecutive years. So these are stocks that are paying increasing dividends, dividends that are regularly and routinely being increased year after year. So it wasn't difficult, wasn't impossible. I lived below my means, invested that excess capital in these stocks, and it allowed me to build the 5-figure and growing passive dividend income my real money and real life dividend growth stock portfolio generates on my behalf, which I call the FIRE Fund. And I call my portfolio my FIRE Fund because it allows me FIRE, which is financial independence and the ability to retire early, FIRE. So, and you can kind of, on the article here, if you're following along, you can click on this link and it'll actually go over to my real money, real life dividend growth stock portfolio, which generates that passive income I just talked about. And that passive income covers my basic expenses in life because the dividend income is, I don't know, I'd have to do the calculator, 80-90% or something of my passive income, and I have a little bit of passive online income, but the bulk of my passive income is the dividend income that my portfolio generates, and that income covers my basic expenses in life, my rent, my food, my transportation, everything I need to kind of sustain myself in life. I don't need to go out and go work at a job or something like that to make the money to, cover the rent and be able to eat and things like that. All that's taken care of now. So it has freed me up to do a lot of really cool things. I'm living abroad as an expat now. I'm working out 6 days a week. I'm at the coffee shop 6-7 days a week. I'm meeting all kinds of people from all over the world, doing a little traveling now and stuff. So it's a really fantastic life because I'm not kind of my energy and time and everything isn't being sucked up by a job that is allocating my time toward tasks that maybe aren't enjoyable or maybe aren't best suited to who I am as a human being and everything else. So once you're free to allocate your resources in a more custom manner that you're able to build a life that's customized for you and by you, that kind of right sizes your life in a very dramatic fashion. It's really, really, really wonderful. So I talk a little bit about dividend growth investing, about why that's such a fantastic investment strategy, as I do in every article, as I've been doing for many years now. I started blogging in March 2011, so we're going on, 7 years now or something like that. So it's been a very, very long time. I've been talking about dividend growth investing for that entire time. It's a fantastic strategy. It's a fantastic strategy for a lot of reasons, and of course I try to talk about slightly different reasons with every different article, and you can just kind of see what that's all about here. And then I specifically talk about, if you're investing in a high quality dividend growth stock, you want to make sure it's within your circle of competence. You want to make sure the business is of a certain level of quality. You want to be looking at the fundamentals, do a full quantitative and qualitative analysis, factor in the risks. And of course, you want to take a look at the valuation, because even a wonderful business, if you're paying far too much for it, it's going to hold you back in terms of your long-term total return potential, in terms of the total yield on your investment, which affects your aggregate income. So it affects your income today as well as your ongoing long-term dividend income. And then it also increases your risk, especially in terms of, at least short-term loss of capital, unrealized loss of capital if you don't sell, but it certainly holds you back. And likewise, conversely, an undervalued dividend growth stock should give an investor a higher yield, greater long-term total return potential, and reduce risk. And then I break down kind of how that plays out and everything, how those dynamics play out. And I kind of laid out the bottom line right here. Undervaluation can make a good investment a great investment. So if you have a pretty good company and you're buying it at a significant margin of safety, well, that can take what would have been maybe a pretty good investment if you bought it at fair value because it's a pretty good company and maybe they're going to do pretty well. It turns it into a great investment because you have that additional upside, you have that much greater yield than you otherwise would have been able to get if the stock were fairly valued, and you reduce your risk. So it turns what's a pretty good situation into a great situation. And then I link over to Dave Van Knapp, fellow contributor Dave Van Knapp's lesson on valuation, which is part of a series of lessons on dividend growth investing and how the investment strategy works, what it's all about, how to value stocks, how to go about looking at dividend growth stocks, how to implement it successfully in your own life. And one of the lessons in particular is on valuation, which is obviously pretty important. And I link over to that. So if you're at all unfamiliar with how valuation works or what it's all about, that'll hopefully clear things up for you. So let's get into the undervalued dividend growth stock of the week. We got the heading right here. It's International Business Machines Corp. I already spoiled the surprise. IBM. International Business Machines. IBM is an information technology company engaged in creating value and solving problems for clients. They provide software, hardware, and technology service solutions, along with related financing. They operate in over 170 countries. So this is obviously a global multinational company. They've been affectionately known for a long time as Big Blue, and it's kind of funny. They're known as Big Blue because they are about as blue chip as they come, especially when talking about the technology sector. And that's because they've shown an ability over and over and over again to adapt to global changes in technology and trends, coming out stronger for it in the end. And they've got a corporate history dating back to 1911. There's a lot of phenomenal technology companies out there. There's, you've got your Apple, you've got your Facebook, you've got your Microsoft, but, you're not going to find... Mark Zuckerberg wasn't even wasn't even a blink in someone's eye in 1911. We'll put it that way. So IBM's been around the block a long time, and they originally focused on what they called their electric tabulating machines. They've always been kind of in data and tabulation and computing and things like that, but obviously that has radically changed all the time over years. So it's not like IBM's had some issues recently with changing the ship and transforming and adapting to new trends. This stuff doesn't happen overnight. I mean, IBM has done it over and over again. We're talking since 1911, it's over 100 years. So they have had to shift many times. But it wasn't like those shifts just take 6 months or something like that. I mean, they take many, many years to write that shift. Has the recent change taken longer than I think a lot of people would have thought, including me? Yeah, it's been taking quite a while, but it's not like the company's in trouble or anything like that. They're still a huge company doing hundreds, well, not anymore, but they're doing what, $80 billion in revenue a year. They're still a huge company. They're still very, very profitable. They still got excellent fundamentals across the board. Would it be nice if they were doing better? Yes. Could that be said about almost every company? Yes. But we'll break into that. We'll kind of get into that here with this article. I kind of just talked about that a little bit. I said things a little differently in the video, but basically just talking about how, look, they've shown a knack over and over again to transform, to adapt to changing trends. They are doing it now. They are making some changes. Some of these changes are working, as we'll talk about, but it's taken a while. The big change that they're making is they're focusing their sales on what they call their strategic imperatives, and that's basically cloud and software businesses, security, analytics, artificial intelligence, cloud computing, things like that. So that's where technology is moving into. Historically, well, not historically, but over quite a few decades, IBM focused on their mainframe business, which are these humongous computers that they would go in and install. So it was a big chunk of hardware, there was associated software with it, and IBM had clients locked into contracts using these mainframes because they took a hell of a lot of time and effort and money to go in and install and set everything up. And so you weren't just gonna, after 6 months, say, yeah, I'm not gonna use that anymore. Once IBM was in, they were in. It was a very sticky business. And that's all changing as computing moves online, as data is stored off-site, as everything becomes kind of digitized and everything. So that's affecting IBM. So what they're doing is they're still trying to keep that mainframe business and kind of their legacy businesses as intact as possible, while kind of saying, okay, we understand that this is kind of going away. We need to really start strongly moving into the new era of computing, which is what their strategic imperatives are, which they've been moving into that, and there has been a lot of growth there. The problem is that the legacy businesses have been declining at a rate faster than at what rate IBM can kind of shift into these newer businesses. So, it's taking some time for that to kind of work itself out and for the business to right size itself and everything. And they've also had they've also gone in and been buying and selling businesses, and overall they've been shrinking as a company in the process through that. So that's affected things as well. But overall, IBM remains a very large and successful company, just not quite as large and successful as it was, maybe 10 years ago. So does that make it a bad investment? No, especially at the right valuation, which we'll get into here. So let's get into the dividend first. I talk about the dividend. It's big, reliable, and growing. None of those adjectives are incorrect. For perspective on that, the stock yields a massive 3.84%, at least when I wrote the article. I'm going to pull up their current yield because the stock market has dropped quite a bit. I think the last couple of days. I'm shooting this on Sunday. I think Thursday and Friday of last week, the stock market just got kind of creamed there. So I know their dividend right now isn't at $1.50 a quarter. I'm pretty sure. Let me pull up Morningstar here if it'll load sometime today here. Give me just a second here, guys. Okay, sorry about that. I had to pause because Morningstar changed their site maybe a few months ago, and ever since then it has been terribly slow. I don't want to complain too much because it's free, but wow, it was so much better before. This new site is really, really terrible. So nonetheless, I still use it because it is just a treasure trove of information. So we've got their current quarterly dividend, $1.50. I was right on that. So it's $6 a year, $1.50 times 4, very easy. We divide that by the current price to get the yield, 148.89. So the current yield is 4.03%, we'll call it. So it is a bit higher than when I wrote this article. IBM, like almost every other stock, at least over the last few days, has dropped quite a bit. The stock market, I think on Friday alone, was down over 2%, and It was down maybe a couple percent or something the day before. I don't follow the stock market on a day-to-day basis, so if you're asked, if you ever come to me and say, hey, what did the S&P 500 do yesterday? I probably won't really know. Just doesn't really impact me or matter to me that much. But IBM has fallen like a lot of other stocks. So almost any stock I would have chosen as the undervalued dividend growth stock of the week for this particular week would be cheaper now. And just because a stock is cheap doesn't mean it can't get cheaper, and just because a stock is cheap doesn't mean that if the market falls, it won't fall too. Sometimes it may fall more or less, but over the long run, these investments, keep in mind, these investments are long-term ideas. These are not trading ideas. These are not, hey, buy IBM because I think next week it'll be up by 4%, you can sell. That's not what we're talking about here. These are building blocks to build the foundation of a portfolio, to build the foundation of passive income that can, allow you financial independence. So these are very, very long-term investments. I personally held IBM for a number of years now, like most stocks in my portfolio. I don't sell too often. When I buy into a business, I plan to be a long-term partner with that company. So nonetheless, it's dropped a little bit. The stock price has, which price and yield are inversely correlated. All else equal, a lower price will result in a higher yield, and we see that's what happened here. So what's happened here is the stock was appealing on a valuation basis when I wrote the article, or at least when I was starting to compile the data and when I submitted it for publication. It's even more attractive now. All else equal, if you like a stock at X and it drops by 5%, so it's X minus 5%, then you should like it even more. I mean, unless something changed with the business. A stock on sale is wonderful. A stock that's on a bigger sale is even more wonderful. So that's something you should really, really look forward to. And just to kind of put that yield in perspective, I mean, we're talking more than twice the broader market, right? And comparing the stock's yield to its own recent historical average, you can see the 5-year average yield on IBM, 3.1%. So it's coming in, when I wrote the article, it was over 70 basis points higher than that average. And now we're talking a premium of almost 100 basis points, which is huge. So what that's telling you is that over the last 5 years on average, investors have been willing to accept a yield, again on average, of 3.1% from IBM stock. And now they're saying, no, we want a yield of over 4% right now. Again, is IBM maybe worth a bit less in terms of how you value the business today versus maybe 5 or 10 years ago? Sure. And you're getting a bit more yield for that. And actually, when I think back to when I first started investing back in 2010, IBM was yielding something like if I remember correctly, 1.6, 1.7% or something like that. It was not a high yielding stock because it was a faster growing technology stock. Well, things have changed, and now you get that big yield in compensation for that. So basically it's low expectations here. If IBM can kind of turn it around a little bit and continue to grow these strategic imperatives as they have been, as we'll talk about, then there's a lot of upside here. There's a lot to like. So let's get back into the dividend here. So we've got the yield over 4%. And you're not just getting yield, though. You're getting plenty of dividend growth, too, which we'll kind of break into here. Let me pull up IBM here on David Fish's CCC list here. So we've got 22 years of dividend growth. And we've got a 10-year dividend growth rate of 14.7%, which is obviously impressive. I mean, if you can combine a yield of near 4% or over 4% as it sits now with a dividend growth rate, a long-term dividend growth rate well into the double digits, there's a lot to like there. And frankly, with a yield of over 4%, which is getting up near some utility and even some real estate investment trusts, you don't need dividend growth of that high to make the investment pretty compelling over the long haul. And just to kind of build on that a little bit, or to kind of extend on that, extrapolate on that point, you can see what's happened with the dividend growth too. It's kind of decelerated. So you've got the 10-year dividend growth rate of 14.7, and then you see a slowdown. You see 12.3, 11.6, 7.3. So this was almost reflective of where maybe IBM was at a decade ago, when it was just a bigger company, a more successful company. And this is kind of maybe a new normal for IBM. So the yield has gone up and the dividend growth rate has gone down. So you see up arrow, down arrow. And is that necessarily a terrible thing? It's a terrible thing if IBM, if this deceleration continues and IBM just gets to the point where the yield continues to rise until it's very high because it's in danger somehow. Then they have to, cut the dividend or do something there, and then dividend growth rate slows down. Yeah, if these two trends continue on indefinitely, then that's not a good thing. But I don't really think that's what's happening here. IBM isn't quite the company it was a decade ago in terms of its revenue, in terms of its sales, in terms of its growth rate, or anything else. But that doesn't make it a poor investment. It doesn't make it a bad company. It doesn't make anything like that. It's just relative to where it was before, but relative to a lot of other businesses, it's actually doing quite well, especially in terms of future potential. If the recent growth starts to kind of take hold and even starts to accelerate a little bit from where it is. So that's what's happened. So again, if you're getting a yield of 4% and the most recent increase was 7, you see it kind of drop down into the high single digits here. If this becomes the new normal and your long-term dividend growth rate that you're going to expect is somewhere in that 7% range, and you're combining that with a 4% yield, I mean your expected total return, assuming a static valuation, should be the sum of your dividend growth rate and your yield. So if you're looking at a yield of 4 and a dividend growth rate of 7, which over the long haul, unless the payout ratio gets crazy, that should be more or less somewhat correlate with earnings growth. I mean, you're talking total return in the low double digits there. That's certainly that's a pretty compelling picture, if you ask me. So not a lot to dislike here about the dividend. It's basically like a utility-like dividend with dividend growth that is superior to what you'd find with like a utility. So there's definitely a lot to like. And you got the payout ratio of 43.5%. I based that on adjusted fiscal year 2017 earnings per share. That adjusted number is 1380 because IBM took a one-time charge, you can see here, $5.5 billion associated with the enactment of U.S. tax reform. So that's a one-time hit. You really can't assume their payout ratio based on that. This is the fourth quarter fiscal year 2017 earnings press release. That's where I'm getting this information from. And so if you look at the $6 dividend against that 1380, you get a payout ratio of 43.47, so 43.5% rounded up. And that's a very healthy payout ratio. The dividend is not in danger, or there should be no concern over the dividend or even the growth of the dividend. Now, would you be expecting dividend growth of the 10-year average of 14% plus? No. But is it unreasonable to expect IBM for their next dividend increase to be somewhere in that that 6 to 8% range like it has been over the last couple of years? No, I don't think that'd be unreasonable at all. I think that's probably right about what you're looking at. And of course, I know the 22 consecutive years of dividend growth for IBM, which is a solid track record, period, for any business, but it's especially impressive in the technology area. And again, that just speaks to IBM's ability to transform itself and its wherewithal to pay a growing dividend and its commitment to paying that growing dividend through all of those changes and everything else. So they're really being tested on that commitment right now with the way things are happening, and they still continue to hand out the dividend raises. And there's been a lot of communication from management recently. They've released some press statements and some press releases, and they've gone through some investor presentations, and there has been specific language explicitly stating that one of their goals is to continue to grow the dividend annually over the long term. So there's definitely a management commitment. There's the wherewithal. You've got the low payout ratio, and the business is frankly not doing that badly considering the massive change that IBM is experiencing. So we're going to get into that now. We're going to get into business growth to kind of look at exactly what that looks like for IBM. And first, we're going to look at revenue. So IBM pulled the key ratios here for IBM on Morningstar. They usually have it pretty accurate. And then, so you can see just kind of a quick look here. You can see that the revenue, they were doing over 100 bill in fiscal year 2008, and now they're near 80 bill. So obviously not what you want to see with any business. And this has been kind of a combination of factors that has happened with IBM. If you look out, if you kind of follow them over the years, and I've been obviously following them somewhat closely because I've been a shareholder for a while now. But it's a combination of things. I mean, obviously the transformation of the business as the highly profitable and highly expensive mainframe businesses kind of dropped off quite a bit. That's certainly affected revenue. But you see a lot of the drop really just in the last few years, and that's also occurred as they've divested a number of different businesses from the company. So they've been very, very active in terms of investing and divesting certain businesses. Overall, though, it's been a net loss in terms of revenue for the company. So that explains some of the sales drop, and then some of it, frankly, is just the business isn't as strong as it once was. So there's no real sugarcoating it, but it's a combination of things. It's not like IBM in 2008 is the same exact company of IBM in 2017, except it's just doing $20 billion less in revenue. That's not the case at all. IBM here and IBM here are really very different businesses in terms of the mix, in terms of the sales mix, in terms of the businesses they have. terms of quite a few things. So to look at these two numbers and just kind of say and conclude that, you know, oh, they just lost 20 billion in business, that's not really the case at all. But we're going to get into that right now. So let's look at those numbers. So I've got the 2008 10K pulled up, and I've got the annual report, and then I got the most recent annual report pulled up. So you can see the revenue here, 103,630, which lines up right there, and then the most recent annual report. Whoop, I scrolled down a little bit past there. And then we got total revenue here, fiscal year 2017 at 79,139. Which you can see right here. So those numbers are correct. So let's do well, I'm not going to do a compound annual growth rate for that because it's a negative number. I mean, we know that they're doing a lot less in sales. We don't really need to break that down anymore. And I kind of talked about that right here. IBM's revenue is actually down from 103.630 billion in fiscal year 2008 to 79.139 billion in fiscal year 2017. And that's due to the changing dynamics across the industry and IBM's business model in terms of, you know, what they're doing. So the change from hardware to software, services, and solutions has been more of a challenge than an opportunity for IBM thus far. No doubt about that. The good thing about this shift has been that IBM has largely been able to expand its margins over much of this period. And that's basically been happening as they've been focusing on higher profitability businesses. And you see that. You see gross margin here. You see that upward motion. And you can see net margin, which I really kind of consider the gold standard for margin. You can see that margin kind of start to really crank up here, up into the 16s even, but the problem is it's really dropped off. This fiscal year 2017 isn't a good example because of that one-time hit due to the tax reform. So this number, excuse me, isn't accurate. But you can see that there was really kind of some upward momentum, and then it just kind of started to drop off the last couple of fiscal years. So you definitely want to see that kind of reverse itself and then get back to where they were at, because one of the a thesis I had with investing in IBM a few years ago was that as they lost some of that business with the hardware, they could more than make it up, even if sales were you know, even if it wasn't a one-to-one gain in sales. So let's say they lost a dollar in hardware business, but they, you know, made it up with 95 cents in software business. Well, that isn't necessarily a bad thing if that 95 cents is at a much higher margin. So that was kind of where I was kind of looking at things. And that thesis was really holding weight up until the last couple of fiscal years. So we want to kind of see that move around. And again, fiscal year 2017 is not a great example for that because of the hit to GAAP earnings. That's not an accurate number, their net margin for that year. So the more important number would be looking at earnings per share, because it actually tells us as they've been divesting and investing and as they've been shifting the business model, as they've kind of seen that growth in net margin that played out until, again, maybe last fiscal year. You know, what has that really resulted in? And keep in mind, too, that IBM is routinely buying back a lot of its stock, too, with the cash flow it's generating from not only its legacy businesses, but also its new businesses and things like that. So we're going to look at that right now. So we've got the 2008 annual report. We've got diluted earnings per share. We've got that at $8.93. And this is one of the instances in which Morningstar is incorrect. I don't know where they got this $8.89 from. I don't know. In fact, I don't even think the 2008 annual report has that number in it, so I'm not quite sure. Maybe I'm wrong. I don't think I am. I've got the 2008 annual report pulled up, and IBM has their diluted earnings per share at $8.93. So that's the number I used. And we've got the most recent annual report, of course, fiscal year 2017. We've got diluted earnings per share here, but again, that's not the number I used because it's not an accurate number. I instead used the operating non-GAAP. So it's not a total apples-to-apples comparison here, guys, because I'm looking at GAAP earnings from FY 2008 to non-GAAP earnings for FY 2017. But that's the best I can do here for you, because this number here, this isn't accurate. This 614, that's not an accurate number. The more accurate number, I won't say it's 100% accurate either, but this is as close to accurate as it's going to get because it factors out this charge. So looking at that, we got 893. I'm going to close David Fish's list there. So we've got 893 as the beginning value. We're going to compound that out and see what their compound annual growth rate was over the last 10 years for earnings per share. We've got 1380 as the most recent number. And of course, as I talked about before, I use Investopedia's compound annual growth rate calculator to calculate the compound annual growth rate for a company's revenue and earnings over 10 years, which I use 10 years as a proxy for the long haul. You can use any any calculator you'd like. I use Investopedia's, but you can use any one you like. And of course, we're using 9 compounding periods because the first year, fiscal year 2008, isn't a growth period, it's a starting point. So we've got a compound annual growth rate of 4.95%, which I reflect right here in the article. And, obviously it's better than what revenue's done, and a lot of that's due to the buybacks, and maybe there's been some margin expansion in there too. And you can see the buybacks right here. Check this out. So they had almost 4 billion shares outstanding. They now have 937. We're talking a reduction of over 30%. Their outstanding share count over the last decade, which I know right here about 32% approximately, which is huge. I mean, especially for a large company like this. I mean, reducing basically a third of its outstanding share count, which is a third of its market cap, on a run rate kind of a thing. That's huge. We're talking billions and billions of dollars in share buybacks. You could argue with that a number of different ways in terms of was it the best use of capital and everything else. Looking back on it with hindsight, they probably could have done that a little differently, because the way they positioned themselves now is the positioning could have been better. It could have been faster. They could have done things a little differently. The buybacks maybe could have been a little less aggressive and things like that. So, you could argue that a lot of different ways. But nonetheless, it is what it is now. And when we invest in a company, we don't invest in where it's been. We invest in where it's going. So we have to really think about where we think IBM is going to go tomorrow, 5 years from now, 10 years from now, so on and so forth. So I will note though that compounding growth rate of 5%, again, it's not terrible, it's not great, considering the number of buybacks. It's not super impressive. And I note here it's not particularly impressive. That's the same language I use in the article. That's what I'd say again. It's not bad. It's not great. It is what it is. It's an okay earnings growth rate for IBM. It's middling. But I will say that some of the things are working. So we've been talking about, I've kind of almost taken a negative stance with this video, and I hate to do that because that's not how I feel about IBM. That's not how I feel about their future. I feel like they are starting to position themselves really well here. It's just taken a little longer for that positioning to happen than I think a lot of people would have thought it would have taken. And probably the most notable example of that kind of maybe disappointment in terms of how fast things have happened is probably Warren Buffett, because through Berkshire Hathaway, he initiated a very large stake in IBM. Maybe too large, frankly. I've been invested in IBM for quite a while, not quite as long as Berkshire was, but I never really took a large stake in IBM. I've always viewed it as kind of just a smaller position, and maybe going in hot and heavy with IBM at that time maybe wasn't maybe investing in IBM at that time wasn't a bad idea at all, especially where they were at that time. But maybe going that hot and heavy with them, not maybe the best choice. But again, hindsight's 20/20. That all said, and I hate to have this negative attitude because it's not how I feel. IBM, the changes are working, and I think the best place to see that, first of all, this last quarter was the first quarter, I think in 20-some quarters or something like that. I don't know the number off the top of my head, but it's quite a few quarters where they actually registered year-over-year revenue growth. Again, because of the change in dynamics, and also because of the way they're changing their mix and they're divesting certain businesses. So that's taken some time for that to kind of right size and start to really move up the other way. But look at this, guys. This is year-over-year revenue growth for strategic imperatives. We got 11% year-over-year growth. That's not bad. That's not bad. That's net income right here. That's not bad. And then we got gross profit margin here. We got cloud revenue growth, 24% for cloud year-over-year revenue growth. So you've got revenue growth here, 11%. You've got 24% revenue growth for cloud as a service annual exit run rate. You've got that right there. These are pretty solid growth rates. So when people kind of slam on IBM's revenue growth as being unimpressive and everything, that's a lot. There's a lot going into that. It's not this, again, as I talked about before. IBM 2017 is not IBM 2008 for a number of reasons. See, it's not apples to apples saying, oh well, look, they were growing revenue before, now they're not. It's the old adage that selling a dollar for 80 cents. You can sell a lot of dollars for 80 cents. It doesn't make you a very good company. So, revenue is just one aspect of a business. Their overall picture is not that great. I'll give you that, but things are working. I mean, we can see the revenue growth starting to occur here, starting to take hold. And by the way, strategic imperatives. I mean, you can see total revenue here at 79 billion. Strategic imperatives alone are over 36. So it's almost half the business now. So again, it's taken time, but it is getting there. I mean, that is where the revenue growth is. You can see total IBM down 1%. And you can see strategic imperatives up 11. So we know what's happening here. The legacy businesses are declining. These are growing. However, this is taking a little while to really become a large picture of a large absolute portion of revenue. This was growing at a very fast rate for quite a while now, but it was historically a pretty small part of the business. So, you know, if you have 100 billion in revenue and you have a $5 billion area of your business growing like gangbusters, it doesn't really move the needle. But it is moving. It's starting to move the needle now because it's becoming a rather large part of the business, and that'll just continue to play out over the future. And I think that's where, if you're investing in IBM, that's what you're looking at. So that's where we see they've been at over the last 10 years. Not a super great picture, but we invest in where a company's going, not where it's been. And looking at, I pull up with every article, CFRA, they have a forward-looking, a 3-year projected earnings per share compounding growth rate of forecast for what they think a business will do. They've got that at 5% for IBM, and that's basically where they were at over the last 10 years. So it's just assumed the status quo. But I note here, I believe there's actually room for IBM to surprise investors with even better growth moving forward, as it seems that they're finally turning the corner after bottoming out. I really do believe that. IBM's been heavily investing in AI, quantum computing, and blockchain technology in recent years, and that positions, excuse me, I'm sorry about that. I ate lunch hours ago, so I'm not sure why I'm like this. That positions the company really, really well as we enter a new era of tech and computing. The last number of years has been disappointing. I've been an investor, I've been a shareholder, so, you know, I'm like, you know, it's not been great for IBM. It's been a little squeamish at times. It's like, can they just really turn this corner? I mean, I believe in them. They've done it over and over again. They are making the moves that you would want to see them make. It's just taking a while. And but that all said, the last 2 years that, you know, they've been putting out these press releases and you know, we've been divesting this and divesting that. We're moving over here. This is what's happening. That's why they're doing that. They're investing in the future of technology, and I think that will position them really, really well going forward. Getting into the balance sheet, which is next. This IBM's balance sheet confuses a lot of people, and you know, I had somebody actually come by the blog and almost kind of try to argue with me over IBM's balance sheet, which is, you know, I'm not interested in arguing about anything with anybody. I mean, the numbers speak for themselves. But IBM's balance sheet, I think if you're not real familiar with financial statements, especially the balance sheet, it kind of trips people up. But their balance, their financial situation in terms of leverage is not bad at all. In fact, I'd go so far as to say they're actually in excellent position in terms of their finances, in terms of their balance sheet, in terms of their ability to cover their liabilities, their interest expenses, and everything else. It's not bad at all. So breaking that down, let's get into that real quick. First of all, IBM has historically financed a lot of their sales and everything else like that. So that kind of changes the dynamics a little bit with the balance sheet. But even just kind of as it sits, let's take a look at that. So we've got long-term debt at 39.837 billion. And if we do a long-term debt to equity ratio, we've got total equity right here at 17,725. I'm sorry, IBM stakeholders equity, 17,594. So we've got a long-term debt to equity ratio of 2.26, which I note right here, and that's high. If you just look at this number and you just kind of do your first level thinking and you don't kind of elevate to a second level line of thought, you're going to say, oh, well, their long-term debt to equity ratio is quite high. IBM's balance sheet's terrible. Well, it's not. First of all, if we look at cash on hand, cash and equivalents, we're talking 12 billion right there. So that's almost a third of, what is that, over a quarter? Let's do the math on that. 11,972, marketable securities, 608. So we've got cash and equivalents and marketable securities at 12,580. We've got long-term debt at 837. So what the heck did I just do, guys? 11, let's do that again. 608 divided by 39,837. So we've got, yeah, it's about a third. So cash on hand covers long-term debt by a third, which long-term debt itself is inflated by the way they record some of this stuff. And then the bigger point though is, you see this treasury stock right here, 163 billion. I've talked about this over and over again in these videos. This is why I don't really consider long-term debt to equity ratio a very viable metric. It's just a number I include in the articles and I talk about in the videos because it's kind of a bellwether metric that a lot of people like to know and they like to look at. I consider it kind of a garbage metric, to be honest with you. IBM, as I just noted a few minutes ago, they are buying back a ton of their stock, right? They reduced their outstanding share count by about 30% over the last 10 years. Well, that sits on the balance sheet as treasury stock right here, and it reduces shareholder equity. I mean, if you were to kind of knock that off, the long-term debt to equity ratio would be nothing. So the balance sheet is fine. I would go so far as to say it's fantastic. And bringing that point home, we'll look at the interest coverage ratio, which I consider more of kind of a gold standard for figuring out whether a company is doing well in terms of covering its liabilities. And that's basically looking at, so I've talked about this in every single video, so we're going to break it down here instead of kind of going through the ABCs a little bit. So we've got income from continuing operations before income tax right here at 11,400. We got to add back in interest expense to get EBIT, right? So interest expense right here at 615, and divide that by the 615. So we've got an interest coverage ratio of almost 20 over 19. I've got that right here. That's a very healthy number, guys. Now I will admit that their balance sheet and their overall financial situation has deteriorated in recent years. That's certainly happened, but it went from a extremely healthy situation to, extremely blue chip, something you would never lose sleep over, to slightly less impressive. That's really what's happened here. And that's what's happened with IBM as a whole. It's gone from a phenomenal business to a less phenomenal business to a very good business. But I think the valuation is great, and that's what brings the stock to our attention. That's what brings it to this video and everything else. So again, the balance sheet is not a problem. The debt is not a problem. Their situation, their financial situation is not an issue. It's not something I would lose even 1 minute of sleep over. Profitability, moving into that, long been a strength for IBM. They've long been a very, very healthy company in terms of their competitive advantages, their economic moat, their pricing power, their sticky business, and everything else. They've been very, very excellent in that regard. And that also has taken a hit as those business dynamics have changed, as I talked about earlier, but their profitability is still rather excellent. And actually, up until very recently, that was getting even better, which is extremely impressive for IBM to go from pretty good numbers to even better numbers. I average that out over the last 5 years, net margin, return on equity. I'm gonna do it again here. You can see net margin here, this line right here, guys, 14.86, 16.14, 12.96, 16.52. divided by 5. So we've got an average net margin annually at 13.55%, which I reflect right here. And then we've got return on equity, this line right here, 32.1, 73.04, 100.96, 69.37, and 79.15 divided by 5. So I did the calculations here. We got return on equity is over 70% averaged out. A couple things to keep in mind though, guys, here. The return on equity, first of all, it's not really an apt number to really look at because the shareholder equity is so low due to the treasury stock. So when people say, oh, the balance sheet's terrible, but return on equity is phenomenal, well, you can't say those two things because you're not really looking at the numbers. So return on equity is not as great as it looks, and the balance sheet is not as bad as it looks. Both those numbers are being skewed dramatically. So return on equity, it's again, that's not a metric I really put a lot of weight in because of that. The net margin is really what I consider the end all be all to profitability because it's basically bottom line. If you're selling $1 of profit, what are you you're selling $1 of product or service. What are you earning in profit, bottom line, after everything's all factored in, cost of goods sold and everything else? What are you actually looking at? And for IBM, that was historically a pretty good number here, and then it got really, really outstanding actually for a number for quite a while there, quite a stretch, and then it's kind of dropped back down. Again, this fiscal year is not really a good number, even though I factor that into the 5-year average. I'm just doing that because that's to keep things consistent, with all the articles, with all the videos. But it's not really an accurate number. Their net margin is somewhere in this range right now, somewhere in the 15s or so, and I'd like to see that even continue to improve, and I think that will as the sales mix continues to become more advantageous to IBM, especially as that strategic imperative line of the business continues to grow much faster than the rest of the business, and hopefully as the legacy business maybe bottoms out a little bit, and as the strategic imperatives become a larger absolute portion of the business, then, large absolute numbers and a large relative portion of the business, then I think IBM really has a nice runway, especially with where they've been positioning themselves in tech and computing. So I note again, it's taken a little while for the company to turn around, but they're still in a very good position. They're still growing at an okay rate. Even if they do continue to grow at 5-6%, which would really be just keeping the expectations very, very low. I mean, that's basically saying the last decade continues indefinitely. All the challenges that IBM's been facing the last decade, as that massive transformation this has probably been the most challenging decade for IBM in their existence. So to say that the last decade has resulted in 5% growth, which is not that bad, and to say that's going to continue indefinitely, well, I think that's a pretty bold statement. I don't think that's what's going to happen. I think IBM has room to do better than that. So if you take the kind of worst case scenario, which is included the Great Recession, the financial crisis, included this massive transformation in the business, I don't think you could paint a picture that would be much worse to IBM other than what's happened over the last decade. And still, they've grown at 5%. They've grown their dividend right through that period, guys. It's yielding 4%, which is getting near some utilities. Well, utility stocks are yielding a bit higher now because they've dropped like the rest of the market. But, 6 months ago, a lot of utilities were yielding 4%. So, you're getting utility-like yield with potentially a lot of upside as IBM starts to really kind of figure out it's where it's at and get its footing. The last quarter seemed to indicate that they're finally turning that corner and things are starting to move in the right direction. So if you can get in while you're yielding 4% and kind of ride that thing up and continue to collect that growing dividend, that sets you up. That's a nice piece for that. I kind of look at my portfolio like a masterpiece, like a painting, or like a big puzzle, and every little business I'm invested in is just one little piece of that puzzle. And this is one piece. This is one little stroke of your paintbrush to just kind of really create that masterpiece. And I think IBM has a place in a lot of portfolios because of where they're at, because of the valuation, which we're going to get into right now. The PE ratio when I wrote the article was 11.54. Let's break that down again because it's dropped. The stock has dropped, the price. 148.89 divided by, that was 1380. 1380. I'm using that adjusted EPS number again, because of the adjustments that they've taken to GAAP earnings per share. So we're talking a PE ratio below 11 right now. So kind of adding some perspective to that compared to where IBM's been at over the last 5 years, their PE ratio. Again, this isn't apples to apples because this number that we're going to look at for the 5-year average is using GAAP earnings, but still, the 5-year average is 12.1. It's now at 10.8. And I don't think that 13.8 number I'm using is terribly inaccurate. I think that's a pretty reasonable number to look at. It's definitely a discount. And look at price to book. Price to book isn't too important, especially with IBM, especially with the balance sheet as I talked about. Price to sales though, you can see the 5-year average here. You can see a discount there. Price to cash flow, this is a 3-year average for cash flow, currently at 8.3, and then you see the yield. So across the board, IBM is looking cheaper than its 5-year average, which itself has been pretty beat up. So the last few years have been terrible for IBM. So to say that it's cheaper even than that is frankly, I think it's saying a lot. So we're gonna now value the stock using a dividend discount model analysis, as I always do. And with this dividend discount analysis, I'm using a 10% discount rate. I'm going to keep that at 10%. When a stock goes over 4% yield, I generally drop the discount rate down to 9. But if it's kind of floating in between that number, if it's just over 4, I'm not going to change that too much. I'm going to keep it where it was at. So we're going to assume a 10% discount rate on this stock. We've got an annual dividend of $6. And the growth rate I use, which of course is important for the dividend discount model analysis because, changing that growth rate by a little bit can change the valuation quite a bit too. I factored in a dividend growth rate of 6.5%. That's below it's well below the 10-year dividend growth rate. It's also even below the most recent dividend raise of over 7%. But I'm factoring in that 5% long-term EPS growth rate. I'm factoring in the CFRA forward-looking 3-year projected earnings per share compound annual growth rate of 5%. So I'm kind of splitting the difference a little bit here, but I'm giving IBM the benefit of the doubt here when I go 6.5. I think that they have a lot of room for upside surprise, because to say that they're just going to continue indefinitely growing at 5 or something like that, and that's where the dividend is going to grow too, would be saying that the last 10 years, which have been probably the worst period that IBM's maybe ever had. I mean, I don't know where they were at in the 40s or 50s. I don't know about that, but at least for anything recent while I've been alive, and maybe even just slightly before my lifetime. This has probably been the roughest 10-year stretch for IBM, and that even includes the dot-com crash. This has been terrible for the company, and they're still growing at 5. They're still growing the dividend at a very attractive rate. The payout ratio is still very moderate, using, again, that adjusted EPS, TTM EPS rate, or at least EPS for fiscal year 2017, which is the same as TTM right now because of where we're at. 6.5 I don't think is unrealistic. I don't think it's too aggressive. So we're going to say 6.5. And that gives me a valuation of 182.57. which I have right here. So I think we're starting to see an IBM that has bottomed out in terms of its business, and I think they're going to start to turn that corner. That most recent quarter really started to show some pretty solid momentum for the company. And of course, I talk about why I use a dividend discount model analysis, as I do in every article. And then I compare my analysis to what some professional analysts have come up with. I use specifically Morningstar and CFRA. Morningstar has IBM as a 3-star stock with a fair value estimate of 168. I note that right here. And then CFRA, they have it as a 4-star buy. And I used their 12-month target price, CFRA, in lieu of their fair value calculation because their fair value calculation for IBM is nonsensical. It doesn't make any sense. They have their fair value calculation at 74.45, which means the stock will be overvalued by like 50%. But then they recommend buying it, and they have a 12-month target price of 175. It boggles the mind. I really don't understand where they get some of these numbers. You know, I think in every video I've kind of always noted kind of some issues with CFRA and their numbers and where they're getting this stuff from. I really don't know what they're doing sometimes. So maybe somebody could email me or tell me what they're doing with some of these numbers or where they're coming up with this. But I guess I just don't understand how you could say, oh, this stock looks overvalued by 50%, but we think it's going to go to 175 in the next 12 months, and we're going to recommend buying it. You know, I don't know. But anyways, I use this number in lieu because the fair value calculation, it doesn't make any sense. It's nonsensical. So averaging those 3 numbers out gives us 175.19. When I wrote the article, or at least when I submitted it for publication on the Thursday before it was published, it was 11% undervalued. We'll take another look at that though. So it was 175.19. It's currently at 148.89. I see that on my screen here. So the stock now looks about 18% undervalued. So it's dropped, 6-7% since I wrote the article, which I think since I wrote this article, the entire stock market's down probably somewhere near that range or something like that. I think over just the last 2 days, it's down like 5 or something. So, you're getting a utility-like yield. You're getting yield over 4%. You're getting a dividend that's very safe, very reliable, rather large, and growing. It's probably going to continue growing for a very long time. This is not the phenomenal IBM Big Blue it was maybe 10 or 15 years ago, but it isn't Blue Junior or Small Blue or Little Blue or anything like that either. It's still a very large company. It's still a very successful company. It's still a very profitable company, and it's still a company that, if I'm making a bet essentially that they're going to continue growing their dividend for many years to come, I don't see why they won't. There's nothing that would indicate that financially that they won't. So the bottom line on this is International Business Machines Corp has more than 100 years under its belt, proving its adeptness at adapting and succeeding. While their turnaround is taking a bit longer than anticipated, the company has great fundamentals, growth in the right areas, and a commitment to paying its shareholders a big and growing dividend, with a yield actually over 4% now, a long-term dividend growth rate well into the double digits, and the potential that shares are now almost, 18% undervalued. There's a lot to like about this dividend growth stock right now. And then Daily Trade Alert also includes the Simply Safe dividend safety score, and as this article went to press, that score is 91, which means it's a very safe dividend. Cut is extremely unlikely. As I just talked about, as we were looking at the numbers, IBM's dividend is extremely safe, extremely reliable, especially for tech, really for any company out there. I mean, the safety of IBM's dividend is frankly safer than a lot of like blue chip, food companies like a Coca-Cola or something like that. So IBM's in excellent fundamental shape across the board, and they position themselves very well for the future of computing as those changes continue to manifest themselves. So there's a lot to like about IBM, guys. I hope you enjoyed the video. Hope you enjoyed the article. Hope you found a lot of value in it. I hope you find value in every article I publish. It's always an honor, of course, for me to publish these articles and to do these videos. I hope you enjoyed. See you again next time. Thanks so much, guys.